So sure, each one of us here will be able to really define those options, like their financial instruments that will give us the right, but we are not obligated, right? There's no obligation, blah, 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 blah. I'm so sure that one, we are so good at it. But now today, I'm here to address one thing called what here? The real options. So when you talk of real options, of course, the definition in this case here, Deborah is saying volume. Are you guys able to hear me? Are you guys able to hear me? Are you guys able to hear me? So Deborah, I don't know how to advise her, but if I were you, I would have told Deborah to get out of Zoom and then she comes back again. She comes back again. You're clear. Great. Very loud. Thank you very much. So when we talk of real options, these are basically options that are classified under capital budgeting. These are capital budgeting options. These are capital budgeting options. So when you talk of capital budgeting, of course, capital budgeting is all about making decisions using what here? Net present value, i.e. NPV, NPV model is involved, is used in decision making. NPV model is used in terms of what here? Decision making. NPV model is used in terms of decision making. So Anna, is that echo still there? Is that echo? Anne is saying there is some echo from the background, which is very good feedback, because we need to work on this echo. We have tried, we have established new studios. We have established new studios now. Now you'll never see Mwalimu going at the back to change batteries. No. Now we are going a notch higher, but now the echo, of course, we need somebody who has been, actually it's much better than how we started. Yes, great. So NPV model is used in decision making when we talk of real options. So all the other things will be there. The D1 equals LN, they'll be there. But at the end of the day, ladies and gentlemen, when it's a real option, then we should always appreciate that real means what here? Capital budgeting. And for us to be able to appreciate this, could we kindly look at May 2016 question number 1? May 2016 question number 1. Antonio, we have a deal with you. I keep on forgetting. May 2016 question number 1. When you get it, please could we kindly mention there that, oh, we have it. Thumbs up. Yes, great. So we are told May 2016 question number 1. Thanks, Steve. We are told the Planet Limited is considering undertaking a 20-year project which requires an initial investment of shillings 250 million in a real estate partnership and whose present value of expected cash flows is shillings 254 million. Planet Limited has the option to abandon the project, in the next 5 years for shillings 150 million. The variance in the present value of the cash flows is 0.09, and the 5-year risk-free rate is 7%. Now, ladies and gentlemen, could you kindly give me the types of real options? Please go ahead and give me the types of real options that you guys are aware of, types of real options. Of course, number 1, let me listen to you. Call option, no, those are the general. Now here we are, yes, option to abandon. So number 1, we have option to abandon. That's number 1. Option to delay. Number 2, option to delay. That's number 2. Number 3, do nothing. No. We have number 3, option to redeploy. redeploy. Option to redeploy resources. Option to buy. We know, but I like this class because you guys are really trying. You guys are really trying. Number 4, we have option to expand. Option to expand. Option to expand. So now, when you are, for example, given an option to expand, you are told in this case here, come and build your house here, lease term 20 years. Should things in this case here work out, we are going to extend for you some extra space, right? So you're going to expand. You're given an option to expand. So if it's an option to expand, ladies and gentlemen, that one in terms of accounting expansion means me putting up more resources. It's like I'm buying extra space. And if you remember, the option to buy, the option to increase is normally a call option. So this one here will always be accounted as a call what? As a call option, as a call option. As a call option. The same case with this delay. Same case with the delay. Ladies and gentlemen, delay, at the end of the day, even if it's delay, for example, you'll come and make some agreement with some people. You tell these guys here, fine, I'm acquiring this property in form of what here? A lease, yes. But I don't want to start investing in Kenya because of the looming bad elections. I would want in this case here to have this venture. Of course, we have it down in writing, but should everything in this case here fall in place very well in Kenya after whatever elections are coming in August, then come September, October, I'll come and start doing what here? Somebody building up my buildings, right? My warehouses. So if it's an option to delay, still at the end of the day, however much I delay, I'll come and make an investment. So I'm buying. Remember, option, call option is the option to do what here? To buy. So delay, again, here will be accounted for what here? Will be accounted as what here? As a call option. As a call option. How about option to abandon? You know, abandonment is the opposite of what here? Is the opposite of expansion. Is the opposite of expansion. When you are expanding, you are buying. When you are expanding, for example, those who believe in polygamous marriages, when you talk of expansion, you're bringing in more people to your family. You're bringing in more people because you pay dowry. So you're buying. It's a call option. But now abandonment, especially if you get a bad man, like that, these men, of course, when they abandon their families, when they abandon their wives, they even go for the dowry. They go asking back for the dowry. So when you abandon, it's like you're selling at a throwaway price. Abandoning. It's a bad thing. Throwaway, but you're selling. So anytime we talk about abandonment, ladies and gentlemen, this one here will be a what here somebody. This one here will be a put option. Will be a put option, yes, will be a put option. The same case here with the redeploy. When you redeploy resources, for example, if I'm told that we need to get some lecturers here from CPA to another department, that's a redeployment. It's like I'm selling them because when I have them going away, I'll be able to save something in my department. So redeploying, you're sending away staff, you're sending away resources. So the gentlemen, of course, when you're sending them away, you're not sending them away for free, you're getting something. So redeploy also is a what here? Is a put option, is a put option, is a put option. So are we together up to there? Are we together up to here? Are we together up to here? Are we together? Great, 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 great. That means I can rub. That means I can come and rub. Yes, great. So, ladies and gentlemen, the question that we have at hand is which type of a question here? This question, is it a put type of a question or a call type of a question? It will be very important for us to appreciate this. The question that we have. It's a put because it is an abandonment question. So if I'm the one doing this in an exam for purposes of demonstrating broad and a deep understanding of the subject, I can even write this in capital letters, that this is a put question. It's a put question since it's what here? An abandonment question. It's an abandonment question. It's an abandonment question since it is an abandonment question. That way you'll have scared the examiner. And the moment you scare the examiner like that, then automatically you're good to go. You're good to go. You're good to go. Great. Ryle, have you finished putting this down? Thank you. Great. So the question that we are having, ladies and gentlemen, here is an abandonment question. Then straight away, what I'll do, I know what I need to do. The first step will be for me to get D1 because it's Black-Scholes model. Come and give us D2, give us ND1, give us ND2, come and give us value of a call, and then lastly, you give us a VP, second last. And then because it's a real option, come and give us the total net present value. Total net present value. So those are the steps that you will have to follow. Quite lengthy, but they are easy marks. Easy marks. Give us D1, give us D2, give us ND1, give us ND2, give us value of a call, give us value of a put, give us total net present value. Wow, great. I know I'm yet to work on sound. I'll be able to work on sound. We are putting up very good studios, very good cameras, of course, courtesy of you guys. Great. So we start right away with D1. Now, is there a student who is able to remind us the formula Black-Scholes, called Black-Scholes? Black-Scholes or Black and Scholes. Black-Scholes option pricing model. Option pricing model, like that. Black-Scholes. So is there somebody who is able to remind us the formula of getting D1, abracadabra, without making reference to their notes? Without making reference to their notes, how do we get D1? D1 equals who? D1 equals who? I may have forgotten very many things, but there is one thing I'll never forget. There is one thing I will never forget. There is one thing I will never forget. Let me see whether there is anybody who knows that thing that I will never forget. D1. Yes, LN. Thank you very much. We normally start with LN. So LN, P over E plus risk-free rate of return, plus the variance divided by 2. Then outside here we have T. Outside here we have T. All over something. I like the creativity of these students. You can see where they are not able to type, they are able to go ahead and express themselves in writing, which is very good. Standard deviation, square root of T. Square root of T. Great. Sherilyn, thank you very much. Great. So come here and give us this P. Remember that this P stands for the spot price. It stands for the spot price. In terms of real estate, not real estate, but in terms of real options, this P, the spot price, is the present value. Present value of future cash flows. From the option. Is there somebody who is able to see this present value of future cash flows? Is there anybody who is able to see the present value of future cash flows? Planet Limited is considering undertaking a 20-year project which requires an initial investment of shillings 250 million in a real estate partnership and whose present value of expected cash flows is 254. Planet Limited has the option to abandon the project anytime in the next 5 years for shillings 150 million. The variance in the present value of the cash flows is 0.09 and the 5-year risk-free rate is 7%. So in this case here, the PV, the present value, the PV is 254. Thank you so much. Thank you so much. Thank you so much. So I can see Felicitas Nduku has put up her hand. Let's get to here. So Felicitas, I've given you a chance to unmute yourself and then you talk to us. Felicitas, you're waiting. We shall overcome, right? Perhaps you had put your hand up by mistake, right? But please feel free to even comment. In the comment section, feel free to ask your question there. And as such, for me to be able to see any hands which are being raised up, I'll have your hand lowered like that. Great. Now, so, ladies and gentlemen, that is P. Then we have E. E is the exercise price. E is the exercise price. So when we decide to exercise this option, when we abandon, what shall we do? We shall receive 150 million. Thank you, Sherilyn. We shall receive 150 million. When we abandon in 5 years' time, we shall receive 150 million. So Planet Limited has the option to abandon the project anytime in the next 5 years for 150. If we exercise the right, we get 150. Now, R is the risk-free rate. R is the risk-free rate of return, which in this question has been given as who? 7%, isn't it? 7% is the same as 0.07. Thank you so much. And then we have the standard deviation. These guys, what they did, they gave us the variance. What they did, they gave us the variance. They gave us the variance of the cash flows. Last sentence, the variance as 0.09, but I'm a clever chap. When I see the variance, I can easily get the standard deviation by doing what? When I see the variance, I can easily get the standard deviation by doing what? By taking the square root of 0.09 years, which will be 0.3 like that. And then there is something that confuses so many students. This T is time, and it must be time in years. It must be time in years, time in years, time in years, time in years. So in this question, is it 20 or 5? In this question, is it 20 or 5? It should be the time for the option, not the time for the whole project. Not unless I don't have the time for the option. The time for the option here is 5. So could you kindly come and do me a favor? Come and look for this. Let us plug in. So this will be ln of P over E. The P, you guys have given me 254 over E, which is 150 into brackets. Here we have the risk-free rate of return. The risk-free rate of return here is 0.07 plus the variance. The variance that happens to be variances, this not square. The variance is 0.09. You divide this by 2. Multiply this by T, which is 5 years. And then everything to be divided by the standard deviation here, which is 0.3, root of time, root of 5. So please ensure that you are able to see, ensure that you are able, ladies and gentlemen, to see where this ln is in your calculator. Where is ln? Hapo kwa on, ukienda kwa on hapo chini, utaona kitu imeandikwa kama in, very important in. Hapo tu chini kwa on hiyo kitu kale yanasumbua hiyo. So ufinye in into brackets 254 over 150 close plus into bracket we have 0.07 plus 0.09 divided by 2. You close, you say times 5. You give me the answer at once. Give me the answer at once. Remember here, we don't say equals in between. You simply say ln, open brackets, 254 over 150, you close, plus, open bracket, 0.07 plus 0.09 divided by 2. Without saying equals, you close, times 5, and then you give me the numerator. So is there anybody who is able to get the numerator for us? The numerator. Yeah, Yagon is giving me a figure of, 1.1017. 1.1017. This one here, somebody is giving me that the numerator is 1.1017 with a decimal there, divided by the denominator. Who can give me the value of the denominator now? 4 decimal places, value of the denominator. Value of the denominator, value of the denominator, value of the denominator. 6708. So 6708 with a decimal there. Thank you so much. So then go ahead and give us the quotient. Go ahead and give us the quotient. The quotient according to Macharia, 164.24. 164.24 with a decimal there. Or 164.23. It doesn't really matter. Whose answer should we work with? Is this 24 or 23? 24 or 23? Pata potea, all of us are speaking of the same thing. Really. Let us not fight. Let's not fight. So that is it. We've been able to take care of D1. Could we kindly get D2? Could we kindly get D2? Is there somebody who can remind us the formula of D2? Somebody remind us the formula of D2. How do we get D2? It will be this diagonal. It will be this diagonal. So D2 equals D1 minus standard deviation root T, like that. Standard deviation square root T. Thank you so much. This diagonal is so important to us. Great. Now from there, ladies and gentlemen, then I should be able to get my D2. So my D2 here will be equal to D1 that we have here, which is 164.24 with a decimal here minus 0.3 root 5. So could you kindly give me 4 decimal places here? Give me 4 decimal places here for D2. For D2, what do we have there? 9715. According to Macharia, this is 9715 with a decimal there. With a decimal there, 9715 with a decimal there. Thank you so much. Now from there, we go straight away to normalization. We go straight away to what we call normalization. Normalization. Hapa kuna mwanafunzi Mluya, msichana Mluya. Kuna mwanafunzi hapa msichana Mluya. Great. FM inawapenda sana. FM inasema kwamba ukisikia normalization tunasema ugali ya Mluya. So ukisikia normalization always unakumbuka ugali ya Mluya. Ugali ya Mluya inakuwa very nice, very sweet. Unaweza kula hata bila mboga yoyote. Inakuwa symmetrical. Kabila zingine zote zikipika ugali haiwezi kuja hivi. Inakuwa symmetrical like that. Hata iguzi sahani chini, haiguzi sahani. Inakuwa hii attribute unasoma kwa kiwe asymptotic, haiguzi hata sahani chini. Namna hiyo. Alafu ni symmetric. Yani symmetric ukikata mara mbili ili 0.5. Lugha zingine zote tusiongee sana, lakini hakuna kisi hawezi fikia Mluya. Hawezi fikia Mluya. Hawezi. Lakini much better. Ni much better. Wengine najua kipika ugali sana nakaribia uji. But you see, Simba ni maisha. Huyo pia kuna kitu kingine ambayo ana excel ni maisha. Tuko. So ukisikia normalization always unakumbuka 0.5 symmetrical. So then we have what we called D1. I forgot my D1 figure. D1 figure ilikuwa ngapi? Somebody ilikuwa 164 something. D1 figure 6424. Yes. Now remember, we must, at the stage of normalization, we must round this off to 2 decimal places. At the stage of normalization, we must round off these to 2 decimal places. So in this case here, 2 decimal places, this is 1.64. And then now you go to the normal tables and give us the entry. go to the normal tables, and they give us the entry. Remember the normal tables, how they look like. You have them at the back of your papers there. You'll be able to see the Z there. The Z goes straight away to 1.6. And then when you want this second digit here, 4, you look for it up there. And then now the Z score will be the number that you're seeing at the intersection here, at the intersection of the two, 1.64, 1.64. 1.64. So they're telling me it is 44.95. So the entry is 44.95, like that. That is the entry. That is the entry. 44.95. Now, after I get this D1, then the next thing then will be to get what we call ND1. ND1. So how do we get ND1? To get ND1, ladies and gentlemen, I'll always start with this. So nasema 0.5. And because D1 is positive, so nasema 0.5 plus the entry. 0.5 plus the entry. So it will be 0.5. You know, I'm saying plus here because D1 is positive. If D1 was negative, I would have said 0.5 minus the entry. So this will be 0.5 plus the entry which is 44.94, which gives me 0.9495, like that. That is the answer. ND1. ND1. So you need to stage your normalization. ND1, N4, no more. No more. No more. No more. What if you're given that other table? That's a good question. And that is why, Winnie, I would really want you guys to buy that powerful calculator. Do you remember that powerful calculator? There's a powerful calculator that will never let you down. Powerful calculator which will never let you down. Do you remember the name of that calculator? It goes for 2,000 bob, yes, 570, 2,000 bob. And remember, every semester, I always try to even give you ideas of how you can save money, especially ladies who are in this room, of how you can save money to buy this good calculator, right? Nowadays, if you look at the beauty parlors, beauty parlor, you'll always get a beauty parlor which has got a kinyozi and a salon here. So ukienda next time you choose kinyozi, alafu nawaambia wananyoa kama mimi, naona hii ni ya 30 bob, naona. So badala ya kusuka na 2,000 bob, the difference unaenda unaweka wapi kwa kakile? Si nywele ni ya Mungu itamea. Nywele ni ya Mungu itamea, umeshapata calculator. Nywele ni ya Mungu itamea. Unageta story. Yeah. We shall overcome, right? We shall overcome. We shall overcome. So long as you buy that calculator, and I will be able Very good. Hata kwa dawa huyu hawezi kubali kunyolewa. Very good. So 0.9495. So one day after you guys buy those good calculators, I would really want to have like one class to show you how to derive this answer directly. Because at times, look at, for example, was it last semester but one? Yeah, they gave us this question and they never gave us the tables. Actually, if I'm the examiner, if I'm given a chance to set, I can never give my students that. I expect them, these are higher level of learning. I expect them to have been taught how to get the T statistics, how to get the Z statistic using this calculator. So I'll never give them. I do not give at all, even at the university. I can't give this Z table. I expect them to use this calculator. So, and in many cases, you always get students, you know, this is an area that students love. So when you don't give them a table, you normally get them off guard. So all of them will be lifting up their hands, calling, in this case here, those primary school teachers who are invigilating exams. Why are we not given the table? Those poor fellas are calling CASNEB, right? So there are no tables. There are no tables. And then when a student now looks at the entire paper and perhaps this is the only thing anajua, inampatia headache. So the question is, why can't you just invest in this calculator for 2,000 bob? Yeah, bob. So that is ND1. You can see another tip there from our good friend there called Uga. Una save tu ya mboga kila siku, unanunua calculator. So tuende katika D2. Hebu nikumbushe D2 was 0 point something. I saw another question. A student who asked, what if D2? What if, for example, what if, okay, first of all, give me the value of D2. What if D2 kwa diameter 2 shall overcome? So D2, what was the value of D2? 0.9 something. 0.97. 715. So 2 decimal places. This will be 0.9 because in normalization, it must always be 2 decimal places. Now, so when I go to ND2, I'll talk of 0.5 plus the entry that I get. And then Bernard up there asked, what if this was a negative? I would have said here 0.5 minus what here? The entry. 0.5 minus the entry, like that. But now, fortunately, this one is a positive. So this 0.97, are you able to get the entry from the table? Are you able to get the entry from the table? Yes. 0.3340, 0.3340, like that. So then ND2 will be equal to 0.5 plus 0.3340, like that, which will end up giving me 0.8340, like that. Thank you so much. So I've been able to get ND2, I've been able to get ND1. What do you think will be the next step in this particular exercise? VC, isn't it? So VC. So come and give us VC. Come and give us VC. Yeah. VC is value of a call option. VC is value of a call option. So value of a call option, is there somebody who is able to remember the formula? Value of a call option, is there somebody who is able to remember a formula? The formula of value of a call option. Yeah, Nick, I really appreciate what you're doing. Nick seems to be very aggressive. Yeah, very good. Deborah is following my footsteps very well. Deborah seemingly, and very many other students, the paper that they liked in high school, not high school, but primary school, like Mwalimu here, was physical education. PE, physical education, yes. Physical, that's how you start value over a call option. Anytime we got that bell calling us to attend the physical education sessions, we used to be so happy, right? So unaandika physical education, halafu nakuja naongeza hapa ND1, hapo nasema ND2, but now remember that this E, the exercise price is futuristic. It has to be discounted. So come and discount this by dividing with E raised to what here, somebody? E raised to RT, like that. E raised to RT. E raised to RT. E raised to RT. E raised to RT. So mwanzo nitatafuta ka E, and this E I would want to see whether there is any student who will be able to give me this value from your calculators. Are you able to see this E somewhere there? Are you able to see E somewhere there? Are you able to see E somewhere there? E. You'll be able to see underneath the log, around there, around where the logarithm is, where the on is, you'll be able to see E. So please ensure that you are able to pick it up and then you raise it to power 5, give me an answer. Like Lucielan is giving me 148.42, like that. E raised to power 5. Don't write this is just for our sake here to try. Thank you very much, Sabrina. 148. Is there anybody, if you guys want to be very honest with me, please be very honest with your father. Today I'm your father figure anyway. Is there anybody who has gotten syntax error? Is there anybody who has gotten syntax error? Syntax error. Syntax error. Syntax error. Syntax error. Syntax error. Yes, first trial. Syntax error. I love students who are very honest. Matthew, yes. Are they only 2? Are they only 2 who got a syntax error? I doubt. So many of them, especially the girls here, the ladies here, most of them have chosen to not mention that they got a syntax error. So remember, kwanza Ryle mbona uone hii kameandikwa na hiyo color, hii color ya yellow, hii color ya UDA. Hapo chini kwa log, LN, unaona kwa LN? LN hiyo kitu ya in. Hauoni mahali kuna ka i kadogo kameandikwa na yellow ukaoni? Umekaona sasa. Thank you very much. Na ako kakala ni kakala ka shift. So lazima useme shift. Lazima useme shift. So hiyo ni yellow color, lazima unasema namna gani? Lazima useme shift. Yaani Kalonzo Musyoka, lazima unasema shift. Yellow. Lazima unasema shift. Very good. So ushasema namna hiyo kwanza. Ukishasema hivyo, alafu ufinye LN. Utaona ka i kamekuja kadogo kwa screen. And then, ladies and gentlemen, in this case, what do? You come and just mention 5 down there. Don't raise again. Because that e normally comes raised. Don't raise again and then you say equals. Don't raise again and then you say equals. Is there somebody who has now been able, Matthew, if you tell me you've been able to get that 148 point something, I'll be very happy. David got it. Ryle, have you been able to get that 148? Thank you very much. Come again. So, Eliza, are you able to see the E? First of all, are you able to see the E? Are you able to see the E, Eliza? Yes, great. So then what do? Because this E is a shift function. It's a second function. Right? It's in yellow. It means for you to access it, you have in this case here to say shift, and then you press that button where you can see the LN. Once you do that, Eliza, you'll see on your screen there a small e being displayed there. It comes up, and once it pops up, like don't raise again. Just come and by the side there say 5, and then you say equals, and then you say equals. Then you say equals, then you say equals. So what are we getting there, Eliza? Matthew has confirmed. Matthew has confirmed only that Zoom does not have that emoji, which I'm supposed to be using in this case here to grab your hand. I wish it had. I would have greeted you, Matthew. It doesn't have. It doesn't have. Eliza has gotten right. But Eliza, I should whip you a little bit. Why? Because Eliza never watched my videos. Eliza never watched my videos. You should have picked this, Eliza, from there. But we shall overcome. We shall overcome. We shall overcome. For CPA students, I don't like pushing them too much. You know, they are juggling. Oh, this thing has that greetings icon. Great. It has. Great. I'll be using it. Yes. Now, ladies and gentlemen, listen here. So I'll come here and first of all evaluate this E raised to RT. E raised to RT. So we have here E raised to R. R, you guys had given me a figure of 0.0 something. R, the risk-free rate of return, you had given me 0.07. 0.07 times time, which was 5. Hapa pia ukicheza utaona cha mtema kuni. Utaona cha mtema kuni aliona nini, lakini utaona cha mtema kuni hapa utapata 0. Because you know body mass, you know nowadays we don't talk of body mass. Nowadays we don't talk of body mass. This has been overtaken by events. Now we talk of BD mass. BD mass, I for indices. So these are the indices. First of all, you need to multiply. Before you raise, you multiply first. So then this one here will be the same as E raised to 0. I don't know. Please try multiplying this for me. 0.07 times 5 ni ngapi? 0.07 times 5 ni ngapi? 0.35. So then could you kindly go ahead and raise? Could you kindly go ahead and raise? We see now Eliza. Eliza, I expect to get an answer from Eliza and Matthew. I'll be so happy. Bila Jabir, thank you so much. We need to round off sana is very two decimal places. 4191, 14191, 14191 with a decimal there. Thank you so much. Eliza hajapata paka saizi, but we shall overcome. At least you have an idea, Eliza. Sasa hapa, value of a call then will be equal to, do we have, in this case here, this present value? Yes, P was given. P was given. It was 254. 254. And then we have ND1. Are you able to remember this ND1? Are you able to remember this ND1? 0.9 something. ND1, Eliza has gotten that 1.42, but you rounded off too much. ND1, 94.95, 94.95, minus, then we have the exercise price. Are you able to remember the exercise price was 150? The exercise price was 150 multiplied by ND2. ND2 is a figure that I forgot. ND2 is a figure that I forgot. 8340. 8340 with a decimal there, and then divide this by 1.4191. Now, if you read the newsline of CASNEB, as I told you some time back here, over 50% of students who fail in this paper called Advanced Financial Management, they are poor in body mass. Body mass. If you guys were to be very honest with me, without hiding anything, if we start counting, the guys will get this correct. I'm telling you, so many guys will not be able to give me this arithmetic from their calculator correctly, most of them. Utakuta wengine from nowhere, and you know Satan is real, ni kama anakuja anaweka kila kitu ati all over. No, inakuwa international disaster. What you do, your calculator has got body mass inside there. What you do, you're supposed to take this times this. You say, don't say equals anywhere. This times this minus, you say this times this, you divide by 1.4191, and then you get an answer. So from Gracie, Gracie, my friend, and I said 153.02. Thank you very much, Joy Kamar. 153.02. Thank you so much, with a decimal there. Thank you so much. But remember, it can't stop there. This is value of a call option, and yet we want value of a put option. We want value of a put option. So value of a put option, most of the students will not be able to remember the formula. That one I know. Value of a put option. Okay, value of a put option, value of a put option. Joy Kamar wants me to award a lady too. We shall give these rewards. Better rewards are on the way. I gave you guys a wrong account, which cannot take more than 100 students. And I can see we are 99. Too bad. Anybody who comes on board right now, they will be able to do what? To watch videos later, because we can't end the meeting now. We can't end the meeting now. We can't end the meeting now. Great, great. Great. Thank you so much. So anytime they tell me to get value of a put, this is how I master this. To get value of a put, you must give me value of a call. You must give me value of a call formula. When you give me value of a call formula, what I'll do, I'll come and take these terms the other side. So then this will be value of a call, right? Minus this P, ND1 plus, this of course when it crosses over, it becomes a plus. E, ND2 all over E raised to RT. When I write like that, I know there is one mess I've done. Is there somebody who can remember, who can be able to pick out the mistake here in the formula? Yeah, very good, Nick. We don't have probabilities in value of a put option. In value of a put option, thank you, Mary. In value of a put option, we don't have this. We don't have this. In value of a put option, we don't have that. We don't have that. So come here and straight away then give us value of a put. So this will be 153.02 minus the present value. This was the spot value, which was 254, plus the exercise, which is 150, all over this ERT thing, which is 141.91 with a decimal there, like that. With a decimal there, abracadabra, apone pole pole two, until you give us like what Felicitas Nduku is giving us, 4.92, 4.7193, Abel Omolo, 4.72, 4.72 is the value of the put option. So from there, is there anybody who can remember now the last step? Now Eliza has become a professional expert. Very good. Very good. Is there somebody who can remember the last step? Is there somebody who can remember the last step? Is there somebody who can remember the last step? Net present value, yes. So come and give me the total net present value, including the total net present value, including value of the put. Total net present value of the project, inclusive of VP. Bernard is confused on this 4.72. How we got this? Bernard, it's a body mass. Just get your calculator. I'm getting -206. Body mass, Bernard, remember. Just get your calculator. Say 153.02 minus 254. Don't say equals anywhere. Plus 150 divided by 1.4191. And then you say equals at the end of it. And then you say equals at the end of it. Yeah. Bernard, I'm waiting for you. Bernard, I'm waiting for you. I don't want to go that way where you do 1, 1, 1, 1. Bernard, I'm waiting for you to get this figure. You've gotten it, right? So the mistake you did when you were doing it in your calculator, I'm so sure you decided to work on it separate. All the students who are very careful, pole nyalong, pole. All the students who are very careful, normally get it wrong in mathematics. You're not supposed to be very careful in life. Usifanya kujifanya kando, uta confuse. Plus this divided by that equals. Halafu andika answer. Kuisha namna hiyo. So in a long, you'll be able to get the video to this to this session straight away after the class. After the class, hata kama utacharge kesho, then straight away you will be able to at least follow. Great. And I would want a meeting. By the way, I would want to set a meeting tomorrow along with all students of Southern Sudan. They're becoming very many. It's a big number. Courtesy of Mayom. Is it Mayom who brought you guys? Must be Mayom. I have a friend of mine called Mayom. So NPV of the project. So the NPV of the project, ladies and gentlemen, here, I remember this project has got a cash inflow which has been discounted of 254. Present value is 254 minus a cash outlay of 250. So then this gives me an NPV of 4. This is the NPV of the project, right? So what about NPV plus value of a put? So it will be 4 plus 4.72, which gives me 8.72. And because it's positive, this is what here? This is viable. The project is viable. Great. The project is viable. No, Lucy, Mayom tuko naye kwa special class. Mayom haizi akapotea. Mayom is a friend. Great. Thank you so much. I'm so sure you guys would have really gotten this question very, very easily. So I would want us to take a 3 minutes break. When we come back, I'll be able to show you what we shall be doing. 3 minutes break. It's important we take a break. Great. So I'm giving you 5 minutes. You attempt this question. Warsaw PLC is considering a new project which requires an outlay of 10 million and has an expected net present value of 2 million. However, the economic climate over the next few years is thought to be very risky, and the volatility attaching to the net present value of the project is 20%. So volatility, is volatility the same as standard deviation or the same as variance? Can somebody help me here? Is volatility the same as standard deviation or variance? It's a measure of spread. It could either be variance or standard deviation. In your case, what do you think in this case it does volatility stand for? Is it because of V variance? It is standard deviation. You guys are very bright. Volatility is standard deviation. I've got good sons and daughters around. Volatility is what here? Standard deviation. Please write that somewhere in your mother tongue. But volatility is the same as what your standard deviation, which is 0.2. So also is able to delay commencing the project for 3 years. Able to delay. So this is an option to delay. So the risk-free rate is 6%. They want us to estimate the value of the option to delay the start of the project for 3 years using Black-Scholes option pricing model. Is it going to be a put option or a call option? For instance, this is a call option to delay. To delay is a call. Because at the end of the day, even if it's delayed, you'll have to buy. To delay is a call. To delay is a call. So I'm giving you exactly 5 minutes. We see how far we'll be able to get with this question. And of course, the students who are watching videos are also expected to pause. You pause the video and do the question. Your work is not really to just look at the answers and then you think that these things are very easy. They're easy when Mwalimu is doing them. When you're doing them, if you're not practicing, they cannot be easy. Now, ladies and gentlemen, these are the answers really. Let's see who got this correct. The correct answer is supposed to be 3.92. The correct answer is supposed to be 3.92. The correct answer is supposed to be 3.92 because the present value of the project is 12. Remember, 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 and remember, and remember, and remember. Remember, and remember, and remember, and remember. And remember, and remember, and remember this. Never forget this. This is so important. You forget this, you get a 0 in the entire question. You get a 0 in the entire question. This is so important. This is so important that P is not NPV. P is present value. P is present value. P is present value. In this formula of D1, P is present value. And then now remember that to get net present value, we normally take the total present value minus initial outlay, So these guys have given us net present value, which is 2. These guys haven't given me present value, but they have given me the initial outlay. They gave me an initial outlay of how much? They gave me an initial outlay of how much? Initial outlay of how much? They gave me an initial outlay of how much? Of 10. So in that regard, I'm able to get my present value. If you take this over to the other side, it will be 2 plus 10, which gives me 12 like that. Right. So is there somebody who was able to give this kind of interpretation to this question? Is there anybody who was able to interpret it this way? Great. Geniuses. Great. Thank you so much. Now, once I have this, and then I have my E, E is the, let me read the question again. E is the exercise price. The exercise price is my E. The exercise price is my E. Warsaw PLC is considering a new project which requires an outlay of 10 million. It requires an outlay of 10 million. Even in future, even if you delay, you're going to pay that 10 million should you exercise the right. And that has an expected net present value of 2. However, the economic climate over the next few years is thought to be very risky, and volatility attaching to the net present value is 20%. Warsaw is able to delay commencing the project for 3 years. The risk-free rate is 6%. So the key thing there that you have to be careful is as regards what year, this excess price. Whenever you're not given any other value, in the other question they gave us like a value of 150, here there is no any other value in between there. So the excess price is the initial outlay. After all, even if they were to delay this thing for 3 years, right, they'll still be required to make that initial outlay. The only thing that this examiner should have done is should have told us that because of the delay, the project price will change maybe to 15 after 3 years to confuse some students here, right? So that's if you have an examiner who is a sadist examiners will always look for ways of confusing students, turning their tables upside down for students. So E is 10. E is 10. I think now we have got everything really to be able to get the D1. So D1 then will be equal to ln P over E, so 12 over 10 plus a risk-free rate. Has this examiner given me the risk-free rate? Has examiner given me the risk-free rate? Has examiner given me the risk-free rate of return? Risk-free rate of return, or let me just share the question with you, 6%. So 0.06. 0.06, volatility has been given. What is the volatility? Volatility, remember volatility is standard deviation, 0.2. Volatility 0.2. So remember this is supposed to be standard deviation squared here over 2. So then plus 0.2 squared over 2 times time. What is the time? The delay period given there is 3 years. 3 years. All over standard deviation again, which is 0.2, root of what year time, which is root 3. So then could you kindly give me the final answer here for D1? Could you kindly give me the final answer for D1? Could you kindly give me the final answer for D1? Could you kindly give me the final answer for D1? There are students like when you got this long time ago, she got D1 correctly, 121.91. 121.91 with a decimal there. That's D1. Oh, Lucy, D1. Who is telling me the truth? Lucy, you can see it is 121.91. Please check again, and ensure that you get the numerator kando andika. Alafu denominator kando uandike. And then you give us the quotient. Then you give us the quotient. You give us the quotient. Then you give us the quotient. Great. So all of us, are we confirming that D1 is 1.2191? Thank you so much. Great. Now that's D1. So from there, come and give us D2. From there, come and give us D2. So how do we get D2? It is this diagonal. So to get D2, we normally take D1 minus standard deviation root T. So it is this 2191 minus the standard, minus this thing here, 0.2 root 3, which will end up giving us what figure? Which will end up giving us what figure for D2? D2. 87.27. From there we go to normalization. From there we go to normalization. From there we go to normalization. So normalization, we have D1, which is 122. D1 like that. So could you kindly give me the entry of D1? Kindly give me the entry of D1. Please give me the entry of D1. Please give me the entry of D1. Please give me the entry of D1. From your tables, that is there. From your tables, D1 entry, 3888, a beautiful number. That entry here is 0.3888. So the moment I get that, then I can easily now normalize this. To normalize this, we talk of ND1, which will be 0.5 plus the entry because the figure here is positive. 3888, which gives me 0.8888, like that, 8 in. Yes, that is ND1. Thank you so much. From there, we go to D2. So the D2 figure that I have, in 2 decimal places because of normalization. Normalization, it must be in terms of 2 decimal places. So I need to come and then immediately here, give the entry. Immediately I need to come and give the entry. Immediately I need to come and give the entry. Immediately I need to come and give the entry. Oh, not visible. Lower part. Lower part. Winnie Velma, are you not able to see this 0.888? Winnie Velma, thank you for raising that, but are you able to see this 0.888? Yeah, what is the difference between ND1 and D1? Now visible. Between ND1 and D1. You see, ND1 is the normal. Is normalized. It's a probability. ND1 is a probability. D1 is like the Z score. D1 is the Z score. Entry of 0.87. Entry point of 0.87 is equal to what? Entry of 0.87 is equal to 0.3078. 0.3078, like that. That is the entry. Then now I need to come and normalize. So to normalize this will be ND2. It will be 0.5 plus this entry, remember. So it will be 0.5 plus the entry of 3078, which will end up giving us what figure, somebody? 0.5 plus 3078, 0.8078, 0.8078, like that. So now the moment I've been able to get ND1 and then do ND2, I know the next thing is the value of the call. Value of the call. I know the next thing is the value of the call. So value of the call is a simple thing. I'm being called for my PE class. I will be the most happiest man. Even right now, like now after finishing this, I'll be able to do my physical exercises. I'll be able to skip at least 100. Yeah, skip 100 times. Yeah, so PE is very, very good. PE is very good. Very good. You become more energetic. One thing I discovered, kama ufanye mazoezi by the way naishi life mbaya sana. Kama ufanye mazoezi. Ndio waingilia kidogo nikawaambia ukiona wale wote sasa wala hawajaangalia video hata moja, chances are physically they are not fit. You can imagine like the class that I've had today, mchana, and I'm okay. And tomorrow in the morning I have AAA at 5. Notaamuka utanipata tu. Right. Sababu ya kufanya mazoezi, niko na roller, nafanya mazoezi. Ukiwa unafanya mazoezi maisha yako yote, productivity kazini, all over, becomes very nice. Lakini kama ni mtu anajipenda sana, hutaki kuguza chochote, international disaster, kuingia depression ni rahisi sana. Rahisi sana. The easiest way of fighting these things ni exercise. Na fasting. Hapana kula kama saa sapa, after this unakula sapa kwa nini? Unangoja kesho, right? That's how you become good in terms of endurance, right? Now, that one will pay me candle, beyond advanced financial management. Now, kuja hapa, so value of a call option. So this is physical education. So this is ND1, this is ND2 over E raised to RT, like that. Great. So first of all, we handle here E raised to RT. So this is E raised to R. Are you able to see the R, the risk-free rate of return? Are you able to see the risk-free rate of return? 0.06. Thank you so much. How about the time? 3 years. Right? Could you kindly multiply this for me? And this will be E raised to this times this. It gives me what figure? 0.18, like that. So then I should be able to get this E raised to 0.18. E raised to 0.18. The most improved student is Eliza. Eliza, she has made good progress. She made very good progress. So E raised to 0.18 equals who? So 1197 with a decimal there. 1197 with a decimal there. Thank you very much. That is value of a call option. Value, no. E raised to RT. So come and plug in here. Let's plug in here. So value of a call will be equal to P. P, we got this as 12. ND1, if I remember very well, it was the one that had got many 8s like that. Exercise price was 10. Multiply this by ND2, I can see it somewhere there. It is 0.8078. Divide this by this 1197 with a decimal there. Then you should be able to move with speed and give us value of a call option. You should be able to move with speed and give us value of a call option. Give us value of a call option. So Lucy gives me a figure of 3.92. 3.92. So in situations where one is not sure whether it's a call or put option and you compute both, yes, you are a bright student, Bernard. In situations where you are not very, very, very sure, what should you do? Compute both. And then, of course, the examiner is always required to mark the correct one. That is why in CASNEB, whenever you feel that you have done a mistake, please never cancel a question. Don't cancel an answer. Don't cancel. Just leave it like that. And then down there, write a big title, alternatively. And then you start solving afresh like that. We are always told to look at the two and then mark the correct. Great. Thank you so much. Yes. So never ever cancel a solution. Yes, never cancel. If you cancel, you're telling this guy, don't look at this. And chances are, even with my experience, the answer that is canceled ends up to be the correct one. I don't know what normally happens. The one that is canceled ends up to be the correct one. Yes. So thank you so much. So here we are. So now we have this 3.92. Now the last thing will be for us to give them NPV of the project plus VC. NPV of the project plus VC. So the NPV of the project, is there somebody who can see the NPV in this project? The NPV in this project is how much? It is 2. Plus now the value of the call option, which is 3.92. 3.92, which gives us 5.92. So that this means that the entire thing is very viable because it's adding value to the business. Now here they messed up a little bit. In this question, they messed up just a little bit. They normally do a lot of good work, these ACCA people, but at times they have small mistakes here and there. So you can see they got this 3.92, but they decided to subtract, which was very unfortunate. They got this 3.92, and then this person came and said that it includes the 2. No, it's never that way. It's supposed to add. Like that. So ladies and gentlemen, that is it. I'm surprised that you guys were able to get this correctly.